All right, today we're breaking down the IPO for a company that is quite literally at the foundation of India's industrial might, Bharat Coking Coal Limited. So what's the real story here, and why is this IPO such a big deal? Let's get into it.
To really get this IPO, you have to start with a pretty basic question. We all know steel is a cornerstone of the economy, but what's that one critical thing you just can't make steel without?
And that's where this company comes in. Meet Bharat Coking Coal, or BCCL. It's a part of the huge Coal India family, and it has a very special job. It's the main producer of coking coal in the country. That's the high-grade stuff that is absolutely essential for steelmaking.
Get this, 58.5%. That is BCCL's slice of India's entire domestic coking coal production. I mean, to put it simply, when it comes to this vital resource inside India, they are the undisputed king of the hill.
And how did they get that kind of dominance? Well, it all comes down to this number, almost 8 billion tons. That's the mind-boggling amount of coking coal resources they're estimated to be sitting on in the super-rich Jharia and Raniganj coal fields. We're talking about a massive strategic national asset.
Okay, so we know who they are. Now, let's get into the nitty-gritty of the IPO itself. What are the key numbers and terms that you really need to know?
So the total size of the IPO is just over 1,000 crore rupees. But the most important detail here isn't the amount. It's the fact that this is all existing shares being sold. Let me tell you what that really means.
It's what's called an offer for sale, or OFS. And this is crucial. It means that Bharat Coking Coal itself won't see a single rupee from this IPO. The money goes straight to the one selling the shares, which is its parent company, Coal India. So this isn't about raising money to grow the business. It's a strategic move by the parent to cash out a piece of its stake.
All right, for anyone thinking about jumping in, you'll want to circle these dates. The key window to act is between January 9th and the 13th. After that, things move pretty fast, with the shares expected to hit the stock market just a few days later on the 16th.
So here's the nuts and bolts of the deal. The price is in a tight range between 21 and 23 rupees a share. And this is important for retail investors. You can't just buy one share. You have to apply in a lot of 600 shares, and that sets the minimum investment.
So, what's the bottom line for a retail investor? It all comes down to this number. This is the minimum amount of cash you need to put up to apply for just one lot of shares, assuming you bid at the top end of that price range.
Okay, so let's flip the coin and look at the bull case. What are the arguments for buying in? What's the story the company is telling about its strengths?
The case for investing here really stands on some pretty powerful pillars. First, you've got that market dominance. I mean, they're the only game in town for prime coking coal in India. Then there's the rock-solid financials. This company has no long-term debt. And to top it all off, it's got the backing of Coal India, the biggest coal producer on the planet. That's a pretty strong combination of stability and power.
But of course, it's not all sunshine and roses. To get a balanced view, we have to look at the other side. Every investment has risks, so let's dig into the potential red flags that the company itself is pointing out.
And this is a big one. Over 83% of the company's revenue comes from just 10 customers. Now, sure, most of them are government-run, so they're probably stable. But think about it. That's a huge dependency. Losing even one of those clients would be a massive hit.
Now, this is a really fascinating detail about how they actually work. You might think they do all their own mining, right? Wrong. Over 72% of the coal is actually dug out of the ground by third-party contractors. That means they are heavily reliant on other companies to run their core business.
Whoa. Okay, you need to pay close attention to this number. This represents the company's contingent liabilities. Basically, it's a nearly 3,600 crore rupee cloud of potential costs from things like lawsuits and tax disputes. To give you some perspective, that potential risk is more than 3 times the size of this entire IPO.
And it doesn't stop with the financials. There are some really fundamental risks here. All 34 of their mines are crammed into one tiny geographic area. That means one single local problem, a new regulation, an environmental crisis, anything, could put their entire operation at risk. And on top of all that, you just can't forget the simple fact that mining is a very dangerous business.
So we've seen the strengths. We've seen the pretty significant risks. How do you put it all together? How do you weigh this opportunity to get a clear picture?
At the end of the day, the whole story can be boiled down to this one fundamental tension. On one side, you have this incredible market power. They're the main supplier of something the country absolutely needs. But on the other side, you have this intense concentration of all their assets in one place, creating a massive single point of failure.
So what you're really looking at here is a classic investment dilemma, right? You've got an undisputed champion of the market, but one that's carrying some very specific, very localized weaknesses. Its strength is nationwide, but its risk is deep and focused in one spot.
And that's what it all comes down to. It leaves us with this final, central question that's really at the heart of this IPO. Does the company's powerful position in a critical industry make up for the very concentrated risks it faces? Well, that's the equation every potential investor is going to have to solve. Thanks for tuning into this explainer.